Hi, I'm Gina Griffo, and all of us here at Parks Capital would like to wish you a Happy New Year. We started out 2021 with an exciting new enhancement to the way we communicate to you about your finances. As most of you know, we start out every client review meeting with a deep discussion surrounding the financial markets. This year we have decided that we will create a macro market overview video. We believe that receiving this video and reviewing the market updates in advance will help enrich our one-on-one conversations. In this video, we will discuss the past market conditions and outline our forward-looking view of the financial markets. We really hope you enjoy this new approach, and as always, we would love to hear your feedback.
Welcome to the macro market update for the first quarter of 2021. I'm your portfolio manager, Rajiv Dixit. We're excited for the new year. Thankful 2020 is over and looking forward to what 2021 has to offer. So let's get started. If we had to design a stress test for our investment strategy, it would look a lot like the year 2020. As most of you know, our investment strategy has one primary goal. It is a simple one. If markets go down, we want our portfolios to go down less than the market. The goal is not to beat the market every time. The goal is not to make as much money as possible. The goal isn't to make more money than your neighbor. The goal is, when markets go down, we want our portfolios to go down less than the market. Because we believe that if we do this consistently, again and again, as long-term investors, we will be able to achieve our financial goals. With that being said, what better year could test this strategy in real time? The year 2020 gave us everything to test against. A 34% drop in the S&P 500 in 34 days came in the first quarter, along with volatility levels not seen in a long time. Think about that. A 34% drop in 34 days. That was only to be followed by the second quarter V-shaped recovery in the large cap stocks. The third quarter, in our opinion, was even more interesting. Markets were showing several signs that warrant caution. Signs that you have heard us refer to as red flags. Signs like the small cap index 2000 not really participating in the recovery as much as we would like to see. Or the fact that money was flowing into the safest place of the financial world, the 20-year treasury bond. Or safe haven commodities like gold holding on to its gain from the pandemic market panic. We believe what was being tested in the third quarter was our discipline to choose caution over our desire to capitalize on every bit of return. At Parks Capital, we raised our cash positions in Q3 and decided we will not chase these returns until we see these so-called red flags turn yellow, as we say it. We found comfort in the fact that even though we have come back from the lows of March 23rd, chasing returns while these red flags were present would not be a smart idea, would not be a smart choice from a risk-return point of view. Of course, every portfolio manager knows that there is a risk of being cautious. The risk is letting the markets run up while you stay cautiously in this defensive stance. But in our opinion, in this instance, that was a cost worthy of paying. The fact is that we are all long-term investors, and knowing that fact is very helpful in managing the portfolio. Knowing that it is not important to match the market return every time, but what is important is to reach our financial goals safely without putting our future at risk. Fortunately for us, the wait wasn't that long, and the price wasn't that big. At the end of September, it was clear that technically something was changing in the markets. Slowly but surely, some of the red flags we had seen before were starting to turn yellow. In the month of September, all equity markets pulled back a bit and then started to recover in the end. It was this recovery that was different than any other we had seen this year. This time, the small cap index was leading the market higher. The 20-year treasuries were no longer showing signs of cautious money flow. Gold was not showing the signs of caution either. Of course, these were just green shoots at the time. But so many green shoots popping up at the same time told us that this could be something real, a real change in the long-term direction of the market. Thus, in the fourth quarter of the year, we started to increase our exposure to equities, cautiously wherever warranted. You have heard us say this phrase before. We started to bring the portfolios from a defensive stance to a more neutral stance. Started to get ready for what could be a positive quarter that leads us into a new positive long-term trend. We're happy to report that to date, our convictions in this instance did not fail us. Our expectation of the market moves higher played out well, and we continued to add our equity positions wherever warranted all through the fourth quarter of 2020. As long-term investors, it is imperative to know when to be cautious and when not to be. When waters are choppy, it is important to show caution. Wait for better times to invest for the long term. But when things are turning for the long term, it is equally important to not be afraid to ride the ride, move into markets, and make returns that would help us achieve our long-term financial goals. We believe this could be one of those critical times. To make our case for the optimism we have for this coming year and beyond, we want to share with you one long-term chart. That chart is a Russell 2000 small cap index. If you know us, you know how much we believe in this index of small cap companies. You know that we are true believers in the fact that small cap companies show us the forward direction of the economy. That's right. I did not say markets. I said economy. They are different. But if you want to invest for the long term and be successful, you need to follow the trend of the economy. And small cap index, in our humble opinion, shows us that trend better than any other tool in our arsenal. So let's look at it. This is the chart of the Russell 2000 index. This point right here, it is October of 2018. If you recall, in 2018 was when there was a tariff war chatter starting. That's what pulled the markets back in 2018. And then markets recovered quite a bit in 2019, but never breached this high that they made in October of 18. From there on, we know what happened in 2020. The markets dropped due to the pandemic and then started to recover in the second quarter, as we discussed, and thereon. The point I'm trying to make here on this chart is that for the past 2 years, this index has been in what we call the sideways pattern. It's never breached its high. It's just basically going down, going back up, going down, and then going back up again. It wasn't till October of 2020 when this sideways pattern, this 2 years of sideways chop, as we like to call it, broke out. You must be asking yourself, why is this important? So what if one index, that too of a small cap stocks, so what if it broke out? Let me show you why by going back to the last time this happened, November of 2016. As you can see right here, the markets were in a 2-year sideways pattern before November of 2016. Right at November 2016, right after the presidential elections, the market broke out. And for 2 years after that, all financial equity markets started to roar higher. For 2 years, right after a breakout of a 2-year sideways chop pattern. Does this mean it is going to happen again? Well, no. No one can say that with certainty. But we would not be doing our job if we do not prepare our portfolios for such an outcome. Of course, if markets were to reverse themselves, they have also now given us a point where we can change our stance, go a bit defensive. The purpose of this update is not to predict the future. No one can do that, of course. The purpose of this update is to inform you of what we're seeing and how we're preparing for it. Of course, if things were to change between now and the next update in 3 months, we would be reporting about those changes and how we adapted to them in the next update or our next conversation. We cannot close this piece without highlighting one obvious fact. The above views of the market and the narration of the past year's events is a general view. You know that every portfolio in Parks Capital is managed based on who you are. It's based on your risk tolerance, your individual goals. Thus, they all look a bit different. Please keep that in mind, and we look forward to talking with all of you in your quarterly portfolio review meetings. Please know that we hope that this content will help enriching the conversations we enjoy having with you during our reviews. Again, thank you for giving us this opportunity to be a part of your financial journey and for the trust you show in us by letting us manage your portfolio. We find ourselves extremely lucky to be surrounded by all of you as our clients. Thank you.